Hi and welcome to another episode of Startup Stories, where I interview the best and brightest startup founders and experts so you can be ahead of the curve with your own startup venture. This episode is part of our Expert series, in which we interview experts in the startup and business ecosystem, like investors and lawyers. Today, I'm excited to share with you an interview my partner and I did with David Hook, Managing Director at Ringier Digital Ventures, the corporate investment fund of the international media group Ringier. In our conversation, we cover many of the questions we asked ourselves as founders when it comes to investors, like what are the most important factors for investors to invest in our startup? How many customers do we need to have before contacting investors? And if an investor is interested, what happens then? We loved sitting down with David and getting honest answers from a professional investor, which is why I'm super excited to share this episode with you today. Enjoy! Thank you, David, for joining us today on our podcast, for taking the time. This is one of our first investors interviews, so very exciting to have you on our expert series. And yeah, we'd like to jump right in and ask you a bit about Ringier Digital Ventures.
Yeah.
Ringier Ventures. What do you do? What is it all about? And what is your role in all that construct?
Okay, I think the easiest question is my role. I'm one of the co-founders and managing director or managing partner at Ringier Digital Ventures. So I'm responsible for the business. And what we're doing is we're doing early stage venture capital investments. That's for Ringier. Ringier is our single investor, but we're doing not strategic investments. It's a big question when we talk about corporate venturing, which we're often, or a term which is often used nowadays. We decided to return on investment-driven corporate venturing. So our main KPI is return on investment and not bringing early-stage companies under control of Ringier, majority investment. So we're acting like a classical venture fund, but use the advantages of a well-diversified media company. So Ringier is active not only in publishing. Often we think about Ringier as Blick and Schweizer Illustrierte, but Ringier is much more. Ringier is nowadays a publishing company in different countries, not only in Switzerland, in Africa, in Eastern Europe, in parts of Asia, but also an entertainment company with radio stations, with ticketing, with sports rights, with events, and last but not least, with the digital part. So Ringier is active in more than 20 countries with classifieds activities in the top 3 sectors. This is jobs, this is properties, and this is cars or mobility. Yeah. And we use the knowledge, we use the reach, invested in our startups, and that's what we're doing.
Right. Is there any? It just comes to mind. Okay, so if you're not strategic, you can theoretically invest in anything.
No.
Right. That's my first question. Is there some kind of a focus?
Yeah, we have. We invest in B2C, internet and mobile companies. So that's really a broad scope. We shrink it down in terms of business model. We like marketplaces in the B2C area. We like direct-to-consumer brands, and we like underlying technologies which support these 2 business models. This is the framework we're working in or investing in. And when we look right now at our portfolio, I would say 70 to 80% is marketplace. We have a little bit of underlying technologies, and the rest is direct to consumer e-commerce.
Yeah.
And this is what we're looking for, and we usually jump in around Series A stage. So sometimes a little bit earlier, sometimes a little bit later, but this is our sweet spot. I looked at the numbers before. 70% of our money was invested in Series A, or from first time investment is 70% in Series A. So
yeah. What amounts are we talking about? Series A Switzerland?
Our chunk of the Series A is between 500K and 1 million.
Yeah.
That's the typical amount we invest. Sometimes it happens that a little bit less, but not often more. We try to follow in Series B and Series C if possible to avoid dilution. Yeah. But overall, according to our investment guidelines, we're not allowed to invest more than 10% of the total volume of our fund into one case.
Yeah, that makes sense. Yeah.
Okay. So, but you also support startups with other things than just money, you said, right?
Yeah. So
you mentioned reach. Can you show in an example how this works?
So we have two currencies. We have on the one hand side the hard cash, and on the other hand we have the media for equity part. So we combine usually our investments. One part is net media. This is the media for equity part, and the other part is cash. Because we believe, on the one hand side, a young company needs hard cash to pay employees, techies, and so on and so forth. But on the other hand, they rely heavily on performance marketing, which is absolutely fine and a must. But often we forget the classical media. Mm-hmm. And we try to offer attractive packages to our portfolio company and get, instead of cash, shares of it, of the company, and that's what we're doing as well. We are often very close to our companies. We're on the board observer, work sometimes on a daily basis with them, not on an operational level, but on a strategic level. But when a funding round is coming up or difficult decisions in terms of strategy, we're very close. And sometimes we also get the knowledge from the Ringier portfolio company. So, for example, from a Scout group, from a Job Cloud group, from whatever. Maybe we need know-how about Africa, so we ask our colleagues in Africa or Eastern Europe, and so on and so forth. And this is a value add which not every investor can offer. Yeah. I hope the entrepreneurs like that offering, but it's not only in my opinion to judge that. So the entrepreneurs need also to test us, to have an opinion about us. We do the same with them. So, and luckily, over the last 4 years, 19 companies said yes to us.
Yeah.
And we said yes to them. So,
yeah. I totally see the value of traditional marketing as well, and building a brand is super important, but it's so hard to measure. It's so you have this. We give you equity, and you give us media attention.
Yeah.
But how do you measure? If that was a fair deal, or
we try to measure everything what we are doing. The hardest is in print. Yeah. That's also the reason why I would say print isn't the least used product we have, but we measure usually in the checkout process. Do you know us from radio, from newspaper, and so on and so forth. Yeah. And we have performance-based products which are only available for our portfolio companies, where it's on a click pay per click model, and you can also measure from display ads if you like that. We had also pay per lead model with the Scout Group and so on. So we try to make it measurable as good as we can. Of course, it's harder than classical performance marketing.
Yeah. So let's say there's a startup who catches your attention. Yeah. What's the process? What's the first thing you do? And then maybe afterwards we can talk a little bit about the due diligence process. Yeah. What do you as an investor look into?
So first of all, we need to get in touch. That's the most important thing. We see 1,500 to 2,000 investment opportunities per year. 90% is inbound deal flow. This means through our network, through co-investors, through Ringier, through our email address, which is on the website, and so on and so forth. The other 10% is really when we see a trend in the market and we go out and contact possible investment targets, and with the message, hey, we wanna get in touch with you and learn what you are doing, and maybe there's a possibility that we invest. Yeah. So these are the two ways we get in touch with each other. Then we look at the pitch deck, classical work, going through the pitch deck, do a screening. We screen along a fixed process. We look at the team, we look at the technology, the product, we look at the market, we look at the competition, and we look at the finance part. So KPIs and financial performance and equity story. Right. These are the 5 screening matrices we use, and then we discuss internally if we want to move forward or not. And moving forward would mean we dig deeper. This is not a full due diligence, but really learning and do meetings with the team. Sometimes we do a call earlier, and so on and so forth. It depends also what type of material they delivered, who made the contact, and so on. Yeah. This is the first step.
Right. So this is all based on, you get the pitch deck and you get most of that from there.
Yeah, of course, we Google around. Are the numbers feasible? About the market size? Are there more competitors out there, or is there really no one? Are the differentiation factors correctly mentioned in the pitch deck? So basic Google research, which could be done in a good amount of time. So if we would dig deep in every case we get on the table, we would be lost. Yeah. This is not doable. We're a team of 3. Yeah, this is a process. Sometimes we sort out very fast with the risk that we miss something. Yeah. But the risk is always here. The Hall of Fame, the deals you haven't done, which get successful, is always bigger than the one you have done. Yeah. That's part of our game. But we hope that we get most out of our screen.
Yeah. How important are the topics of problem solution fit, product market fit? Do you test specifically for that, or do you have they have a little bit of traction, so that's good?
Of course, we'll look at the product market fit, which ends up in traction and KPIs. So we look at that. We look also, is there really a problem in the market, and how is it solved? Because when you have a solution and you need to create a problem around it, it's always more difficult and more expensive. But at the end of the day, especially in the early stage phase, I still believe it's also still an art to do good investments than it's a pure science. Because over time, the KPIs will change for sure. But you need to understand how good the KPIs right now and how good can you improve, or how easy and how far can you improve the KPIs over time. This is part of the due diligence. Yeah, but at the very early stage, of course, we talk about a lot. VCs use technology, have super algorithms to identify the most successful startups. I do believe we can track data points, but you need to get the best out of it because it's not always the truth, because over time the data points will change.
Yeah.
And you need to spend time, or a lot of time, with the team to get a certain feeling if you as an investor, or if I as an investor, believe that it's really this team which will make it.
Yeah.
And these are fundamentals when we talk about product market fit, and especially the underlying KPIs and so on.
Yeah. So you talk about traction, and I mean, we're working on our own startup, and it's always the question: how much traction is enough traction? You know, and the questions came up. Okay, how is it in software? How is it in hardware? How is it in B2B, B2C? Can you give us some examples of good traction and bad traction?
I can't give you a number.
Yeah.
So you need to reach, I don't know, 100K turnover per year, whatever. This would be wrong. For us, we need to see that you have the first KPIs. So in terms of customer acquisition costs, GMV or turnover or whatever, and we need to see that you improve these numbers over a certain period, and then we check what's the potential. I think that's for us a good traction, that we see that you are able to improve, to grow, that it's not we're buying us turnover through very expensive customer acquisition and so on. So you need a healthy balance in your KPIs. You need to be able to show us that you can scale these KPIs or scale the numbers, and that's for us good traction. And it's harder to invest in a case which has in January top numbers, in February bad numbers, in March okay, and then 1 month later top, then bad, and so on and so forth. This is not the case we're looking for, because you have every month a new surprise. Yeah. So we really want to see that you work on your traction and on your KPIs, and that you understand the logic behind your business model. Sometimes we get business plans which are hard-coded, and I need to write back, sorry, I can't work with hard-coded financial business plans, because I want to see how you build your business plan. Do you understand your business model right? So if I invest in marketing, for example, in an e-commerce case, is my customer after the first purchase positive on a CM margin 2 or not, and so on, and how you calculate that, and so on and so forth. These are the traction we are looking for, and the fundamentals you have in your financial business plan, and which also should represent your business model at the end of the day.
First you gotta track it, and then you gotta show an improvement, and know why, which levers you can influence.
Right. Yeah, you need to know where do you have influence on your number, and which number influences another number.
Yeah.
So if I spend more in marketing, and it ends up with a higher customer acquisition cost, but I have higher baskets at the end of the day because I target another customer group. Maybe that makes sense. But if I just show I have more customers but with lower baskets, it ends up in a lower lifetime value but higher acquisition costs. That does not make sense. And so we need to see the logic behind, and you as a team need to understand your KPIs and your numbers and your drivers in your business model. It's about the drivers. Sometimes we're missing that, and that's an important part when we look at early stage investments.
Yeah, you said sometimes we're missing that. Is there any mistake that you see founders do again and again and again? If you would say the biggest mistake founders do that you see?
It takes usually longer and it costs more. That's the biggest mistake in business plan. Or what we see often is this, that we have a calculation in the business plan or in the financial planning with total wrong assumptions. Sometimes they do not know it better. It's okay, but they need to learn quickly. Maybe they have to do one or the other iteration. But often we forget that it's not a sprint, it's a marathon. And when we look at the super successful examples, they started not when they got famous. Airbnb, Uber, Google, you name it. They started a long time, years before they got famous. And we noticed, they are huge. They were super fast. Of course, in the overall adoption was super fast. But from a company perspective, till they really hit this super high growth phase and got famous, they worked also a couple of years and a lot. And we often forget that, and that's sometimes missing in the business plan. That it's not a sprint, it's a marathon, and it costs money, especially when you go international, and probably you're not the only player out there which has the same idea like you have. Then it's about execution and good execution, know your numbers, know your business model, and work hard every day.
This long phase in the beginning is basically, to come back to what we talked about before, is the product market fit, finding that step, right? So that's what can take.
I mean, when you look at the Airbnb story, they changed the business model not 100%, but the reason why, or the big bang, why I should use Airbnb wasn't there. And they started very little in one town and for one conference and so on. So they needed this time to find the right way, and they haven't got a lot of money at that time. Barely nothing. I don't know if it's true. They lived off the different credit cards with different limits they had. So the more credit cards you had, the more cash you had, because every credit card had a 5K limit, and so they lived out of that. I don't know if it's true, but it's a good story. But that's familiar to me. But that means so they went also through this phase of finding everything, the right product market fit, and find the path through this jungle of a marketplace, a two-sided marketplace, and how can I scale it, and what do my inventory wants, what do my customers want, and so on and so forth. The same is for Google. At the beginning, they didn't have big money on their account and the biggest investors, and they find someone who believed in it, and they worked through. And so I think that's sometimes a mistake. It's hard to say it's a mistake, but we want to show that we have good traction. We want to show we can scale fast, and so on. And investors ask for that, but also the investors to be critical about ourselves, we need also to be patient and also tell us sometimes that it takes longer than we sometimes believe. But otherwise, it's not always a classical mistake in the decks we got. Of course, sometimes you have a big smile on your face when you read about certain ideas, but you never know. They believed in it or they believe in it. I don't. Maybe someone else is doing it. Good luck. And that's not the right fit between a startup and Ringier Digital Ventures. And that happens. That does not mean, that's very important, that really does not mean when you get as a startup entrepreneur a no from a venture capital fund that your idea is bad or your business model is bad or whatever. Sometimes it does not fit with the stage they're investing in, with the scope, other things, I don't know.
Could be a personal thing.
Yeah, it could be a personal thing, whatever. But sometimes you see, that's maybe a mistake. We see often that you get this, I call it the window shoppers. They see, here is VC on the website, and they invest in startups, and they send us their business plans. It's a business plan about a biotech company. I'm very sorry. It's clearly written on our website that we do not invest in biotech. So make an investor list, make a short list, and do not go out and send your business plan to every investor in the world, because the probability that most of them say no and you burn your name is pretty high. So choose your favorite investor, try to get them, and if it doesn't work out, go to number 2 or maybe number 3, or build a consortium with number 2 and number 3, whatever. This is maybe a mistake. I see often.
So what should we as founder do to approach the first ones? What is a good strategy?
So from my perspective, or from an investor's perspective, the best deal flow is through our trusted network. Because I know my friend XY will not send me any crap. Because
who's your friend?
XY.
XY, noted.
XY.
I got it.
Do not send me crap, because he is burning his name as well. That works vice versa between investors. If you have someone in your network which knows us, for example, or another investor you want to approach, try to go through him, because that gives you a portion of trust. I think it's totally normal that a human has different levels of trust at the beginning, and the first impression counts also for our business. And when you get a warm welcome introduction through a contact of us, that gives you just this little advantage. Or another good way is maybe at the conference, if you can catch them up. But basically, their investors are busy and get approached from a lot of startups, and then you need to catch him in a couple of minutes or seconds, whatever. The time frame there is very close. But if there you have, or if it works out that you give him a good impression at the live chat, the short live chat, I think this portion of trust is also here, just from the face to face. I think these are the two best ways. Of course, you can go through cold call, an email, whatever. But so we look at everything, and we try to answer every entrepreneur's question or a possibility to invest. But I mean, we're in the overall game still, in the worldwide game, a small fund and a small name. But if we talk about index venture, if we talk about, you name it, Lakestar and Creandum and Northome and so on and so forth, when we talk about the Europe names, and then you have the US names, they're even bigger. Yeah. I do not know if they really answer cold calls, if they even look at it, because they get so many. Yeah. So there you need to go through a contact. Yeah. But it's funny because they're doing aggressive and good scouting. So I see often our portfolio companies at the very early stage get contacted from these big funds. Hey, we like to get in touch with you. Let's talk about your business. It sounds interesting. So they have really good scouting, really good scouting, like a big soccer team. They have scouts everywhere. Yeah. And so our job is to select the good ones at the early stage, and then try to bring him to one of these scouts and bring him up to the bigger funds. And this is also part of our job, that we have good connections to the next stage funds. So we're not able to lead a Series B nor a Series C. Yeah. And so we need to hand it over to a new lead investor, and this is, I see it also as one of our jobs, to have a good network there to open up doors. Yeah.
So it is probably a strategy as a founder to go to the smaller ones first, because there you get more open doors than just go straight to the big ones.
Yeah, sometimes it's also possible to go straight to the big ones, but I think it's natural that you start with the closer ones, with maybe the smaller ones. Maybe you get also there more attention than from the bigger funds, but usually the bigger funds have their multi-stage, so they have an early stage and early stage team and the startup stage team and the growth team and whatever. Yeah. So they have the manpower and they have the money. Yeah. And the tendency is really the bigger getting bigger. So we see this trend not only in terms of financing rounds, also in fund sizes. Yeah. That the fund sizes are getting bigger. Mm-hmm. Not here in Switzerland, but around us. So we need to be aware of that fact and work on that we also have bigger funds, or at least a couple of more 100 million funds. So we're not there yet. We are not there. But to be competitive as a Swiss ecosystem, we need to do that.
Yeah, there's enough innovation going on in the country.
Yeah.
To invest in.
Yeah, especially in the high tech area. Yeah. Biotech, really deep tech, ICT. In the internet and mobile B2C space, we're not so good, I would say, compared to other countries or on other startup hubs. But especially in deep tech, I think where with ETH and EPFL in the area of Basel with this whole biotech cluster, we have very, very good surroundings to have a fruitful ecosystem. But we need to keep our eyes open because the other ecosystems are not sleeping.
No,
when we saw what happened in Berlin in quite a short period of time, we can say about the summers, or everyone can say about the summers what they want, but they have done a lot for the German ecosystem. We see a good growing ecosystem in the Nordics. France is picking up. Around Paris is happening a lot, and for us also very close is Israel, which is super active and big. Yeah. So it's interesting, especially for us as investor, which is not limited to Switzerland. We can invest abroad, but the selection process is even harder.
Yeah. You probably see a lot of technologies that are not ready for the market or are not broadly adopted by the market. Is there one thing you've seen that is completely crazy and that you think will change somehow the way we do something in the future?
To be honest, we do not see so often a lot of underlying technologies because we're not the fancy underlying technology investor. But of course, we see stuff, we read about stuff, and we always talk about these big hypes, artificial intelligence, robotics, and so on and so forth. For me, artificial intelligence is one of the biggest things I've ever seen, but it's also a bit a buzzword right now. So we're not there yet, according to my opinion, where we say we are or where we hope we are. It takes also a couple of months, maybe years, to get there, that it's really artificial intelligence. Right now it's often machine learning. To be honest, we talk about AI, but it's machine learning. A good example is still when we nowadays see a cat and someone tells us that's a cat, we know it's a cat. And I don't know how many times we have to show a computer from different perspectives, different sizes, this could be a cat. So the difference are still big between really artificial intelligence like we humans have or machine learning where we are right now. Of course, if the machine learned it in the correct way, they may be faster, maybe more in detail, more correct in their decision, but the time to learn to train that is still huge. A lot.
I think we have one last question that we usually ask all our guests. And do you have a book or any type of other content that you've recently read and that you would recommend to entrepreneurs?
I don't really recommend books or podcasts or blog posts, just one single
episode
or book or chapter or whatever. I do believe there are a lot of interesting stories out there. What I believe it's the most interesting and inspiring stuff, maybe it's a book, maybe it's a podcast, is learning from successful entrepreneurs. So when they talk about the learnings they have made. It's also still very interesting for me. And I was this morning at the gym and I listened to an interview of Daniel Ek, the founder of Spotify. What drove him to make Spotify and what was the key learnings from doing Spotify. And in a time where piracy in the music industry was big, so he said the most important thing I had to do is building trust from a customer perspective, but also from a music industry perspective. So he had a two-sided marketplace, and both sides the market was on both sides really damaged, and so in this kind of market environment, you start to build a company. So these learnings, or maybe from the Google founders or the Facebook founders, or also companies which failed, I think these are the most interesting and inspiring stories. And I often look at interviews or podcasts with really the founders. Of course, there are some which do the marketing stories, but a lot of them are quite open. That's also for me very interesting and also an inspiration, and I can learn a lot from these interviews. And then reading just theories and so on and so forth. But of course, it's a part of our jobs, especially to inform ourselves about future trends, about future technologies and the possibilities of it. And this is also something what founders should do, but also learning from the successful or founders and some founders which had failures and failed
There's a lot of learnings in that
also
as well.
There is a lot of learnings.
Yeah.
And hopefully with these learnings, you avoid one or the other mistake.
Yeah, this has happened to us. So we listen to a lot of podcasts and read a lot of books. Podcasts, This Week in Startups, Traction, Massive Scale. So there's a lot of podcasts with interviews, the one you mentioned as well. And you come really, when you do it regularly, you have situations in your day where like, oh no, wait, this guy said something about this topic. And now we interview founders, and that is so valuable because we can directly relate to that story. We said, oh, he did it this way, let's not do it that way, because so it has been so helpful for us.
I mean, also, for us, it's the interesting thing is we invest a lot in marketplaces. So, and we have a good knowledge from the Ringier marketplaces, classifieds. So we learn what worked at Ringier, we learn what worked in our portfolio, and we try to tell this to the newer ones, the younger startups, that they do not fear these problems one more time. That's so important and saves a lot of money at the end of the day. Well, to reduce it down, it saves a lot of money and it saves time. For me, it's totally okay to do a mistake, but doing it twice is not the best idea for an entrepreneur, but also for us as an investor. Doing the same mistake twice with two different companies, maybe we can avoid that. We really can avoid that through a close relationship with our portfolio companies. But sometimes you do not have the chance to see the problems coming, and sometimes it hits you.
Because it's always different situations. So, but definitely good advice. Learn from others who've done it before.
Absolutely.
Thank you so much for your time.
Thank you for having me, and hope it was interesting for you and for all the listeners.
So interesting.
If you have a good startup, please contact us. If you have questions, please contact us as well.
Yes.
We're happy to help you or to see at your pitches.
Exactly. We'll leave all the links in the show notes. Click there, and then you have the direct contact to XY at Thanks, David.
Thank you.
That was it. Thank you for listening to another episode of Startup Stories. Make sure to check out the show notes with additional links at nerdentrepreneurs.com. And if you liked our podcast, leave a review on iTunes. Cheers!